Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Nick Brathwaite, founder and managing partner at Celesta Capital, to discuss what capital deployment could look like in the coming months into 2023, pending market factors. Nick, it is great to have you with us, certainly top of mind when we think about what's happening in the private and public markets. What strategies are VC firms deploying with a lack of confidence in the volatile markets that we're experiencing?
Well, the strategies could be broken into two parts. First, of course, with existing portfolio companies, what we're doing to manage through the current situation, and then, of course, regarding new investments. With the existing portfolio companies, all strategies are based on trying to find a way to extend cash runway. So working with companies to make sure that they cut down their burn rate, cut costs if necessary, making sure that they have solid business plans, et cetera. For new investments, there is increased sensitivity, obviously, to valuation. There's more focus on solid business models. For early stage investment, there is more of a focus on path to revenue. For latter stage investments, there's more of a focus on path to profitability. But I think what you'll find is with existing portfolio companies, a lot of emphasis is going to be placed on probably things like insider rounds versus external rounds in the near term.
In my mind, this reset sounds like it's almost a good thing, that you're looking for companies that are perhaps better structured or actually are profitable or producing revenue. What do you think capital deployment could look like in the coming months into 2023, pending market factors? And do you think I'm not saying more due diligence, but more discipline around the types of investments that are being made is going to be something that's around for a while?
I think so. I think certainly this market that we've been in for the past 6 to 10 years have led to, I would say, in some cases, not at the same level of discipline or scrutiny that existed in the past or should exist. Some of us knew that this was coming. None of us could predict exactly when it was coming, but this market could not persist forever. When you had companies with no revenue and no near-term chances of revenue being valued at billions of dollars, there were concerns around that. In our situation, in our own firm, we've been very sensitive to this and have been looking for ways to manage through valuation by structure, doing things like adding warrants and other things to try to control valuation. But there is no doubt that there is going to be renewed focus on the disciplines around traditional investing, including things like focus on the management team and the quality of the management team and governance and path to revenue and path to profitability and good solid business plans.
Why are companies looking at existing investors for future investments as a strategy through the markets?
I have to admit, I'm not aware of a lot of companies doing that. I'm not really aware, but I would imagine that there are two reasons companies might look to do that. One is to get more value-add investors on board, people who can add value beyond just financial capital, because a lot of the challenges some of these companies are facing, as we were talking about earlier, is things like path to revenue, path to profitability, managing cash better, and all of those things. And in order to do that, sometimes having the right investors on your board who can help guide you through some of these challenges is important. I would imagine that's one. The other one I would imagine would be to strengthen the syndicate. You don't want to have a situation where you have one deep pocket investor and a number of other small investors who may not have enough cash to help take you through tough situations like this. So like I said, I'm not aware of a lot of companies doing this, but those would be two reasons why I would think companies would look at this.
And Nick, what sectors still represent a strong investment opportunity?
But I believe deep tech, the sector that we're in, still represents strong investor opportunity because the conditions of the market have not changed the fundamental thesis, which is that a lot of the technology that's needed, the core technology that's needed to drive current and future market trends don't exist today or need to be upgraded. That hasn't changed. And I think this now presents an opportunity for investors in the deep tech sector to get much better deals than existed in the recent past.
All right, Nick, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.